Good morning. I'm Michael Walton. I own and run a business called Rynda Property Investors. It's an FCA-regulated investment management business that I set up 12 years ago when I left Citigroup. The business is primarily focused in continental Europe. We have 6 offices, and in those 12 years we have done absolutely nothing in the UK. However, that is something that we're actively looking to change now. Our main areas of activity are France, where we have 3 offices. We manage about £500 million for ADIA in one location in Lyon, where we have a dedicated office, other offices in Paris and Lille. We have offices in Germany and Amsterdam, and we're headquartered here in London. Our clients range from sovereign wealth funds, of which we look after 3. We have various formats of investment, be they non-listed funds, or more recently we've done a lot of single type of joint ventures with people like Starwood and Tristan. The most recent activities that we've been involved with have actually all been focused in Luxembourg, and I'll perhaps come back to that later as to why. We're particularly looking at Belgium at the moment, and in the last 2 deals we actually did were debt deals.
Okay, great. Thank you. Simon.
Hello, yes, my name's Simon Williams. I'm head of investment here at BNP Paribas Real Estate in the UK. We are an advisory firm in the UK in terms of real estate, but we also have some development activity, particularly in London, where we developed the Google HQ recently, and we also look after, through our real estate investment management funds and also sovereign wealth funds and clients across Europe, where we have about 20 billion euros of assets under management. In terms of what we've been up to in the UK on the investment side of things, over the last 2 or 3 years, we've averaged somewhere between 2.5 and 3 billion a year in terms of the value of the deals that we've advised on. This year will probably be the same as we head into the end of the year, and the sort of people who we're looking after are a real broad range, ranging from the standard sort of UK funds and insurance companies through sovereign wealth, through high net worth private individuals, both from this country and from Asia and the Middle East, who we access through our platforms in the wealth management teams at the bank.
Great, thanks. Will.
We raise capital for a range of managers around the world. We've got offices in London, New York and Hong Kong, and we also get involved in M&A and other investment banking advisory work.
Well, I'm David Inskip. I'm Director in the European Strategy and Research team, although primarily my focus is on the UK. Personally, I've got an economics and forecasting background, really. For those of you that aren't familiar with CBRE GI, one of the world's largest real estate investment managers. Globally, we have assets under management totaling about $88 billion, which is split across our direct, indirect and listed platforms. In Europe, we have about 28 billion euros assets under management, and I would say particularly focused in the areas of retail and logistics, and with about 13 billion of that being in the UK. So we do have a strong UK focus as well.
Okay, great. Thank you, David. One of the, interesting, picking up on Deep's presentation, but also your sort of economic background. It's looking like we're still at a low, sustained low growth. Maybe interest rates might tick up, but that's, we're still looking at very historically low levels. Low bond yields, therefore. Even if we put Brexit aside, how do you see the impact for, let's say, starting with the UK, but also then broader European markets, just from that macroeconomic picture before we look at the politics side of it?
Well, yeah, from the macroeconomic picture, I think you and Sukhdeep have summed it up very well there. It seems every time we look like we might be building some momentum, there is a new disruption. Whether that's necessarily a bad thing for real estate or whether that just gives us a longer, flatter cycle, that's to be seen. I know that the bond yields, the low interest rate environment, that is a key driver of real estate pricing at the moment. Our clients are certainly, they're looking across all of the asset classes, and when it comes to property, they are seeing good value there.
Okay, good. And one of the things that I just wanted to pick up as well, I mean, we talked a little bit about Brexit there. Michael, I was talking to you earlier. I mean, let's pick up a little bit about the politics, and I'll pick that up with Will in a minute. But actually now, you haven't been looking at the UK, but you are now thinking of looking at the UK. Is any of this sort of Brexit related? Do you see more opportunities, or is it something different?
I think it's perhaps the work that we've done on tax, and when you're an overseas investor looking at many of these jurisdictions, the tax position since the global financial crisis has got materially worse in most of the European countries, where in the UK it really hasn't changed. There's been an awful lot of really quite large tax changes, particularly in France regarding the use of carry-forward losses. And a lot of changes to fin capitalisation, the amount that you can offset against any surpluses that you're generating. So I think we've done a ton of work on that, and basically now beginning to focus on the kind of northern parts of the UK, principally to perhaps get out of the effects of Brexit in the kind of southeast. And actually we're seeing quite a lot of value and really strong tenant demand in locations where there's been no real development for 15 years. So those are the type of things that we quite like. I'll come back perhaps later on lot sizes, but that's really one of the key drivers.
Okay, good. And Will, obviously, CBRE Global Investors, you were looking at these risk kind of things, but now also at Hodes Weill, then you've got that kind of global overview in a way in terms of what the investment firms are looking at, how they perceive UK and indeed Europe within that global context. What are you seeing in terms of the political risks, and how are your clients seeing those?
Okay, look, it's a fascinating picture because if you talk to, I'll give you a couple of examples. We were talking to a large Korean institution just before Brexit, and they said, look, we've got 300 million we want to place somewhere in the world, and we want to focus on the UK and the US. So that was early June. By early July, the instruction being ignore the UK, US only. Now that similar institution has turned its attention back to the UK as well as the US again. So I think the UK has dealt with Brexit as well as it could have done politically, and therefore some of the capital in the world that was looking elsewhere or ignoring the UK because of that political risk that had been created has now turned back to reconsider it. Part of that is currency, because obviously the pound has devalued a lot. So if you're getting a 20% discount anyway, through currency plus some valuation changes, it makes a big difference. I was talking to one of the big Chinese insurance companies yesterday morning, and they, again, were the first time in months raised the UK and were basically asking us what we thought about the UK market. I think since Brexit, we've seen a lot of private capital from dollar-denominated private, generally Asian capital, filling the gap that has been left by some of the institutions not knowing what to do. But I think some of the institutional capital that's dollar-denominated around the world, particularly from Asia, is now looking back at the UK for currency, primarily currency, but also they want to know if there's any distress they can find.
Okay, that's interesting. And Simon, are you picking that up? I mean, have you seen a change? I mean, there was obviously a Brexit pause. The question was, is that then move from a pause into a massive depression, or what happened, Simon? What did you see in the market? I mean, we've seen from Sukhdeep that some of these things didn't quite come in the way that people would expect. But what have you seen in the market, and are you beginning to see the sort of lift that Will is talking about?
Yeah, it's been interesting because I think actually the impact on sentiment of Brexit seemed to be worse before than after the vote. Once the vote happened, people thought, well, we now know what the answer is. And at least uncertainty was removed from the equation, because I think markets, in terms of sentiment, react probably to a greater or more negatively to uncertainty than they do to an unexpected result, because at least they know what the result is and then they can plan in accordance with that. So what I think we've seen has been very interesting. Will's absolutely right. I think a lot of the overseas investors have been attracted not only by the fact that our currency has gone down, but also I think, you know, if you take a step back from political events and just look at the real estate cycle, we're probably about 12 months ahead of what's been going on, or what traditionally time-wise goes on in the real estate cycle in other major markets in Europe like Germany and France. So people are looking at those other markets and seeing them probably at the peak of their cycle. We've come off. Our peak was probably about a year ago. Maybe the sort of, and it's a gentler sort of cycle than we saw obviously in 2008, but maybe things have been accelerated a little bit by political events, and people are now not only seeing a buying opportunity if they're overseas because of the pound, but also because there's greater value for money to be had in the UK in terms of yields and returns than there is in other markets. There's also a little bit more choice, I would say, because our market is much bigger and much more liquid and transparent than some of the other markets. So we've seen the overseas money come in, but actually political events also have unexpected impacts. And I think with the austerity sort of regime sort of filtering through to local authorities, they've been using their capital accounts and also their very cheap access to money through the Public Works Loans Board to start getting involved in the real estate market as well. And they've probably accounted for 3 to 5% of the deals over the last 12 months that we've seen in the market, and they've replaced some of the funds money that hasn't been being deployed in the market and sort of taken up some of the slack. So politics can have interesting impacts in unexpected ways, but the market has actually been surprisingly okay. As I think Sukhdeep said, it was a sort of long-term average volume in terms of deal size. About 45 million, billion rather. So we've done better than we expected.
And so this is the local authorities here because they're fearing a loss of funding from Europe, who are then investing in UK real estate.
Yeah, they're having their grants cut from central government, so they're trying to replace income that they've lost from central government by investing in real estate, because that offers, you know, reasonable levels of return, sort of 4, 5, 6%. And they can sort of fund services from the income that generates.
Right. And David, from your point of view, from a CBRE Global Investors point of view, obviously, you know, there was this is a slightly brighter, I may point out, view than there's been expressed recently, so quite interesting, because there was a lot of discussion about, yes, okay, we're not seeing the effects of Brexit yet, but that's because we haven't even started negotiations. We're in the midst of the sort of phony war part of it. How are you seeing the UK within a European context? And are you kind of keeping your powder dry, or are you thinking now's the time to invest because a lot of the market will be out? What's the sort of, you can tell us those kinds of secrets, David, because there's nobody here. What's your perception of it?
Well, I think, some parties have certainly been disappointed, I would say, by how well the UK has held up, the economy and the property market. There was certainly a lot of opportunistic international capital that was immediately looking at the UK, but most of it went away again because it simply couldn't find the discounts that it was expecting to find. I mean, we've seen a very similar thing with what's happened with the retail funds. Obviously, it was very high profile when so many had to gate, but actually they've been very successful in making orderly sales, and we're actually now seeing positive net inflows into those funds, and it's meaning that some of the assets they had on the market, they can actually withdraw from the market. So from some participants' point of view, actually what we've seen is very disappointing. It's not the sort of correction that they would have wanted to see. And I think this is sort of setting out the scene for what we're going to get over the next few years. We talk a lot about the uncertainty, but really I think what we're looking at from Brexit is a slow burn, where you get sort of news drip-fed. I mean, the last time we really had any news on it was at the Conservative Party conference. We haven't really had anything new since then. And it is going to be that slow burn with small bits of information coming out gradually and maybe moving the market when they do.
Okay, good. And Will, I just wanted to pick up with you. We've obviously still got the spread versus bonds. Do you think that's going to irrespective of what may be happening in, let's say, in politics and the allocations people might choose. Do you think that we're still going to see more and more money, capital coming into real estate because there's still that difference with bonds? How do you see that?
Well, look, we do a survey every year with Cornell University, and we published that about 3 or 4 weeks ago, the 2016 version of that. We call it the Allocations Monitor. So basically, it's a survey of about 230 institutions around the world, a truly global survey, which asks questions like, what do you expect your allocation to be in the coming for 16, at the end of 16, and what is it likely to be in 17? And it's continuing to rise, including 17. These are minimal rises, but it's 9.8 up to 10%. So this is hitting that kind of 10% barrier that most people seem to conclude is a sensible allocation for institutions to real estate out of their whole portfolio. But at the same time, we also ask a kind of arbitrary question, which is a 0 to 10 scale on conviction, where 0 is no conviction and 10 is total. And that has been dropping quite rapidly. And we've done the survey for the last 5 years, and it's fallen every year since we started. So I think the world of investment, pension funds, whatever it might be, loves real estate because of its income, but knows we're a long way through the cycle, and that's why that conviction index continues to fall. But with bonds so low, and obviously that's changed slightly recently, bond rout, I thought that was such a crazy headline, because they actually went up 300 basis points, 30 basis points, and doubled, but still they're incredibly low in a historic sense. While bonds are still so low, there is almost no other option to get the kind of income return you can get from real estate.
I think that's a key point in terms of the capital coming in, and also what's driving that. I want to return slightly to also Sukhdeep's last slide there. You're invested, Michael, in both the Netherlands and France, elections there, and Germany, of course. I guess, how much of that do you think we're going to have any surprises there? And how much? I mean, one of the things that came up was Le Pen. I kind of thought, Virginia, you're French, so you can answer this question later. But that in the same way that we ignored what happened here and said, no, that can never happen here, in the US as well. Do you think there's chances for Le Pen in France? Does that create an issue for you? Also, how do you see the elections in Germany and also in the Netherlands? Or is that not really part of your investment focus in a way?
Actually, I think it is very much part of our investment focus. I think that it has a really big impact upon the Brexit negotiations, because there's a lot of people focusing on their domestic politics, won't really be very interested in what's happening with Brexit. And I think what the Trump election has done is actually, on a global scale, deprioritise Brexit in what's actually globally important. And I think these elections are going to do that as well. What I can be completely certain on, in France and to some degree in Germany, but in France we've had like 1,000 tenants for 12 years. And if you monitor the number of lease negotiations that we conclude on a quarterly basis, which we have done, regardless of what's happened in the French economy and the global shocks there has been, there's always been somewhere between 15 and 18 transactions a quarter, with the exception of the last presidential elections in France. So I think that if we're considering transactions in France, we're going to build an extra 3 or 6 months into the void periods, all associated with the political effect or the economic effect of the elections. The elections here are always very short, and there's not really time to react. But there's a very long type of process, obviously in the States, but it's quite a long process in France, 2 rounds over a month, election of the candidates, which is ongoing at the moment. So I think that really will have a big impact upon on what we're looking to do.
Okay, good. One of the questions I've got up here, which is, with Trump's win, are European markets now a safe haven? Is the UK safest of all? David, what's your view on the sort of Trump effect? Interestingly, I looked back because PropertyEU is 10 years old, and in 2006, we did an interview with Donald Trump. We're flown over to do an interview with Donald Trump, so I've just requested that we do another one. So we'll see what happens with that one. He may be a little busier than he was then, I don't know. So David, what's your sense of the Trump effect? Do you think that will have a positive effect on Europe, or do you think there's too many things basically also happening in Europe for that really to have an effect?
Yeah, I think there are things closer to home that are going to have larger impacts. I think Michael pointed out very well that what do these things do? The US election and the elections that we have coming next year all sort of push Brexit down the agenda a little bit, sort of deprioritise. But the thought that the US election result could make the US no longer a safe haven, I think that is too much of a leap.
So you don't think that that's going to scare money from going to the States in that sort of global sense? Simon, in terms of what you're seeing, are you beginning to see different types of investors coming into the UK market? Have you seen a change, whether it's US investors? Will was obviously talking about Korean investors and Asian investors. What have you been seeing in the market here?
There is an appetite, I think, from Asian investors certainly, and also from Middle Eastern investors, because I think they see things in rather a different context to the way we see things in terms of political disruption. To them, Brexit really doesn't seem to be such a huge issue, given the fact that in some of the countries where they're making their money, politics is a much more brutal affair quite often. So I think what they are seeing is that we know now that there's probably not going to be a general election for another 4 years, and we have a pretty stable government that can, I think, as David said, try and do its best to unpick the complications of getting out of Europe in a way which is as least damaging as possible. So I think they have confidence that the UK is going to remain a pretty stable place to park their cash. So we are seeing Asian investors, we're seeing Middle East investors. There is American money, but they're perhaps a bit more opportunist in terms of the sort of returns that they're looking for. And as David again said, they're probably not quite seeing the market adjustment that they were hoping to see. So they're being a little bit more cautious in how they deploy their money. And we're probably seeing people who are coming from other parts of Europe a bit more than we've seen over the last 2 or 3 years. The German funds seem to have an appetite now, and I think that's a reflection of where we are in our market cycle, and the fact that the pound's become a bit more cheap against the euro. So they're coming back in, and the German funds tend to be very canny about when they enter and exit our market. So that's been quite encouraging as well.
And that's driven pretty much by the drop in the currency.
That and where we are in the cycle as compared to their cycle, and I think just value for money, really, fair value.
Okay, good. Yes, Michael, yeah.
Yeah, I just had a thought. I don't disagrry with any of my panelists here in terms of the equity side of the investment market. But I think that, one of the effects of Trump is, protectionism. There's, a process that's been going on now for 8 years in terms of the deglobalization of the banking system. And I think what we are seeing, particularly in the non-prime markets, and those are markets that we tend to look at where we rely on debt because we're a value-add type of investor. I think that the debt market in the UK for smaller deals outside London is become unbelievably thin. And I think that people are looking to advance 5-year loans are thinking to themselves, well, we've got all the negotiations and we don't know what type of environment we're going to expect repayment back in 5 years. So I think that, for the equity investors or the whole equity investors and the type of targets they're looking for, that's not going to have an impact. But I think there could be quite a severe impact that is anything, I think, going to get more squeeze going into 2017 in terms of the availability of debt on smaller, more value-add deals where there's a bit of vacancy, which is important for the maintenance of value in those sectors of the UK.
That's a point because, interestingly, for the past kind of, I guess, really 2 years and even the last year in terms of when you're talking about development finance, mostly something that 5 years ago was taking up half the discussion, ends up taking up virtually none of it at all. So is there anybody else who's got a view on, particularly on that debt side of it, whether that's going to impact availability of debt or how we see that through the next year, through 2017?
Yeah, look, debt is getting more expensive, and that's going. If bond yields keep rising, then debt will only get slightly more expensive still. So, I was in a ULI, the capital markets group recently, and it was a really interesting debate because on one side you had one of the guys from the big German funds saying he viewed the UK as a longer-term safe haven. So not necessarily a safe haven in the next 3 years, but a 10 to 15 years. If you look across the world, it's a longer-term safe haven. And then you had one or two of the value-add specialists in that group, well-respected groups, basically saying, look, lower growth, higher debt costs. For us, this doesn't work as well as it used to. So you've got a real a difference in views across the market. But debt's getting more expensive, so, and in certain cases, I agree, harder to find.
And do you think in that sense that if you've got those value-add players finding it more difficult, is that also true of the sort of private equity players with the kind of fixed 5-year window that they're looking to invest in? Because there seems to have been, it'd be interesting to see your view on this, Simon, as well, seems to be more of the private wealth coming into the market at the moment or seeing opportunities. Is it more difficult now for the private equity players?
Well, they always play. I mean, the big private equity players tend to play the sort of cycles by picking a sector and sort of and you know, exposing themselves to that sector, and they look for some fairly high rates of return. So they're looking, you know, mid-teens up to the low 20s in terms of their IRR over a 3 to 5 year period. I think with the potential in terms of total returns for there to be a sort of very, you know, no total return really, given the sort of the balance between income and yield compression or yields going out slightly, it's going to be pretty hard to hit those returns unless you can grow income. So it basically revolves around what sort of view you take of the real economy, the real world, because that's what really will generate the income flows in terms of rental and tenant demand and so on. And so you've got to sort of pick your sectors. So and what we're seeing is, you know, there's a huge appetite, for example, for logistics at the moment because people see the structural changes in the way people shop as having a beneficial impact on that market sector, and there is an awful lot of tenant demand in that sector. So they're sort of using what's going on in the real economy just to see where they can, and sort of backing sectors that will do well as a result of things that are going on in the real world. I mean, they'll still try and get debt. That will be more expensive, so that'll impact on the overall equation in terms of returns. And they'll try and deploy their capital as you know, as beneficially as they can. So it's going to be tougher for them to find deals that hit their returns. And they've gone out and raised equity in an environment where it looked pretty plausible that you could get a sort of mid-teens return over the last 2 or 3 years. So there's usually a mismatch between the sort of promises they've made to investors and by the time they finally get their hands on the cash, what they can actually achieve in the market. Yeah. But they seem to manage somehow, and I'm sure they will again going forward, but it'll be tougher, I think, yeah.
Okay, good. You brought up the topic there of sectors, so let's have a quick look at the sectors. From your point of view, David, are there particular sectors that you think in 2017 are likely to outperform? Simon's already mentioned logistics. There's a lot of activity in that market, particularly, you know, especially we've had P3 being bought by GIC. We've also got Logicor likely to list. What's your sense of the sectors? Where do you think you expect to see strongest growth?
Well, I would completely agree with Simon on the industrial and logistics points. Also, I think he made a very good point that you reach points where there is great uncertainty, and you also reach points in the cycle where you have to be cycle aware and you have to take a step back from that and start to think more about the big structural themes like demographics, technology. And one of those big themes does continue to be e-commerce. And we look at that at both ends of the spectrum. We see the opportunities for the big box logistics, and I think it's very interesting that what we've seen over the past year is that the investor base for that sort of product has really widened, and we've seen international money that would have previously only considered central London offices now looking at that sector. But at the other end of the scale, we also have the very small units around urban areas where the supply has gradually been eroded over a very long period, and that's really in demand now for the last mile logistics as well. So I would pull out logistics really as the star performer.
Okay, good. And do you see now, I mean, there was obviously a lot of talk before about, the death of retail because there would be pure play e-commerce, whereas now we're kind of looking more at the death of pure play e-commerce in a way. How do you see the impact of that on the retail side? Obviously, you're quite a big retail investor. How do you see that across Europe?
You're completely right. We're seeing an increasing number of the pure play online retailers deciding that they need some sort of physical presence as well. And all that is going to do is accentuate the momentum that the prime, dominant, the best locations have at the cost of the weaker locations.
Okay, good. And Michael, you tend to not necessarily be playing in the stronger, more dominant locations. You may in fact be looking in some of those more value-added, weaker ones. What are you seeing in terms of the sectors that you're working in? Are there particular areas that you're targeting for growth? And also, I think the UK part of it is an interesting one.
Yeah. I think, we look after some very, very prime retail in Lyon, and that's going tremendously well, and I think that's not really affected by e-commerce, and I think we as a business we're generally not involved in anything but prime retail. In terms of sectors that we like, we're pretty strong on offices in the UK, but in the north of the country where there's short-term letting opportunities, we think there's real strength in demand for tenants, so we're very happy to take on vacancy and risk now, but not necessarily with breaks in 3-4 years' time. So we'd rather have the challenges of letting up now rather than in the future. And we'll go for smaller lot sizes up to 20 million, probably north of 7.5 million to 20, and that's an area that really is not so many institutional players. It's outside the size of private investors. So that's a sector we're looking at and beginning to put some transactions together. Shifting, across the channel. We're pretty cautious on France. We just can't see things to buy. We look at a huge amount of deals, but just don't end up doing any or being outcompeted. In Germany, we've just tied up a joint venture to invest in second-tier cities on offices, but again, smaller lot sizes up to about 20 million. And there's just a little bit less competition in that sector than the big six and big deal tickets. So we've got some money. We've got our first transactions going through now in that sector. In terms of the rest of Europe, we've been a very strong fan of Luxembourg. We think that's going to continue. In terms of the strictness or tightness of supply in that market, we're actually doing a lot of work in Belgium at the moment because we think that's just a little bit behind the curve in terms of focus of capital.
Okay, good. And why Luxembourg at the moment? I'm interested because I was asked whether or not I would go and do an event in Luxembourg. So why Luxembourg?
Well, what we have seen over the last 3 to 4 years is that every service provider in Luxembourg has increased the number of staff that they have. Anybody that, be it Google, be it anybody that's basing companies in Luxembourg has moved from 2 to 3 people to 5 to 7 or 15 to 20, because they're all increasing their presence in Luxembourg so that they've got a better permanent establishment type of format because of all the things that are happening in tax. So if you look at Luxembourg, there's about 4 big owners of all the land. There's always been very restricted supply, and we bought a big building last year with Starwood to particularly take benefit of what we hoped was going to be a tightening of the supply, and we let the rest of the building to Swiss Life during the summer. So there's those impacts that we think will continue, and not quite the same things happening in Belgium, but Luxembourg's a bit special in terms of the amount of demand there is there.
Okay, good. Simon, I wanted to pick up with you Sukdik mentioned obviously the potential issues of a much harder Brexit on office. What's your sense of that? Who would be the winners? Who would be the losers? Can everybody really move from here to Frankfurt? Seems a bit unlikely, even if you liked Frankfurt that much. Sorry to anybody who's from Frankfurt. But what's your sense of that? How big a risk do you see that?
Well, there's a risk, I think, that if we don't have passporting rights, that parts of the financial services sector will need a presence in Europe in order to continue to operate. Of course, a lot of the banks that are in the city and do quite a lot of their work in the city are European banks, so that actually won't affect them. And they should be able to continue doing what they do here if the staff want to stay. And I think that's the key thing, really. It's about people. The city and London has probably the best infrastructure in terms of the service sector of any city in the world, probably bar somewhere like New York. And you can't just transport the whole ecosystem to Paris or Frankfurt overnight just because we've lost some passporting rights into Europe. So there probably will be an impact if we have a hard Brexit. I don't think it'll be a disaster, because I do think that most of the services that are already carried out in the city will continue to do so. But people might have to do things in order to sort of have some sort of technical compliance with their ability to sell certain services across Europe. And if they're not already there, sort of introduce some sort of representative office there to do that. Having said that, I have to be honest and say nobody knows at the moment, because we just don't know the shape and the scope of what will eventually be agreed. So it's going to be a very interesting discussion.
And just to clarify on that, do you see that's, I mean, do you think therefore that the fundamentals of the office market within London and the cyclical nature of it generally anyway mean that although there will, irrespective of what the Brexit is, that it won't have as big an effect as people are thinking?
Well, you've got to sort of take London not as a single market in terms of offices, but as a series of markets. And I think what we've seen is that parts of the city, and I'm talking about London rather than the City of London, which have a sort of broader tenant base and which perhaps have been doing rather well out of what we call the media tech sector, which are some of the more creative industries. They've led the market really over the last 6 or 7 years since the financial crisis. The financial services sector hasn't been as big a player over the last 8 or 9 years in any event as it was perhaps for the preceding 10 or 15. So what we've seen, and it's good in any healthy economy, is as one sector has quietened down, other parts of the economy have sort of picked up to move into those spaces. So what we now see, if you look at a sort of rental map of London, is that the traditional core, certainly in the City of London, is worth less than what was seen as the fringe areas now. And places like King's Cross, 70 and 80 pounds plus per square foot, and space excluding the skyscrapers and the towers in London, in the City of London, are sort of 60 or 70. So, and if it's a very small suite, maybe more, but I think what we've seen is probably, sectors rearranging and the sort of world, sort of the tectonic plates of the market in London rearranging around what's happening in the real economy, and I think that will continue. I think financial services have been quiet. They'll probably continue to be relatively quiet going forward, and people will wait to see what happens with passporting rights. So there will be an impact, but it's not going to be as huge. It'd be interesting to hear David's view, actually. Yeah.
Well, I mean, if I could add something to that, thinking about the potential winners, I think we get very focused on financial services, and I would say if we think about relocations of financial services from London, then it does seem like Frankfurt might be the obvious relocation. But then you have to ask yourself, would you be investing in Frankfurt to make that play? You're going into a city that's very focused on financial services, and we know that there are problems with the health of the banking sector across Europe. It's not just a Brexit issue. Would you do that, or would you prefer to go into a more diversified occupier market? For me, maybe the winners would come much more if the clampdown on immigration is so tight that the tech sector, as you've spoken about, finds it hard to recruit. Maybe London stops being the tech hub for Europe. Maybe that goes to Berlin, Stockholm even. And that would be a really interesting opportunity.
So actually the migration issue may be more of an issue than the passporting rights in terms of the financial services. Well, in terms of the allocations report that you've done, one, I guess, is it available? can people download it from your site?
You can download
should they
it
wish?
from our website.
Okay, good.
Available.
I will put a link on ours to yours then, in which case, and then you can have a look at that. But in terms of sectors, is that giving a review on the sort of sectors that people are looking at? What's your sense of where global capital is looking in terms of the sectors?
The report doesn't really go into that much depth. It shows how certain regions of the world are looking at other regions and how that crossover works. So the most interesting thing for the UK that came out of that report was actually the sentiment to the UK increased. Most of the respondents responded after Brexit, and they responded more positively about the UK in 16 than in 15. It's a bit of a surprise. So. Maybe reflecting some of the other risks that are around the world. I think capital is seeking expertise, and expertise comes in all sorts of different ways. So, for instance, within the CBRE group, when I was involved, and the guys have carried on doing it, they've grown a very big pan-European open-ended core fund. But basically, working on the expertise that group is big enough to invest well across the whole of Europe at a core level. So that's expertise, but you go to the other end of the scale, some of the most successful raises we're doing at the moment are wrapped around very specific expertise. For instance, urban retail regeneration in the top 10 cities in the States, for instance. So capital will seek out expertise at whatever level it needs it, be it core, value add, even opportunistic. And I think that pretty much goes around the world now. There are managers doing every level, everywhere you want to go, even places like Vietnam, or Peru, or Brazil. You've got to be pretty brave to go into markets like that. But there are global diversifiers around the world, some of the biggest investors around the world. CPPIB recently said that their best investment in 16 will be Brazil, because they invested in REITs in Brazil at a minus 80 to NAV discount, and that's now a minus 20 discount. So things like that going on. So there are global diversifiers going into smaller markets. I think this market and Europe generally, if you talk to American investors, they'll say, look, it's a low growth environment, Europe as a whole, and then they'll try and pick out what that really means. So if you're a big US global diversifier, and you can look at Germany, for instance, and you can borrow at incredibly low rates and buy an office building for 4.5%, put a lot of debt on it, your cash on cash looks pretty attractive compared to almost anywhere else in the world for that level of risk. So, why not do that? So there are all sorts of interesting sort of derivations of where capital is finding its way globally.
And in terms of those niches, Simon, I mean, let's look a little bit at the locations, since Will's brought that up. Let's look first of all at the UK. Where should people be looking? We can talk a little bit about London, whether there's specific areas that you think are undervalued or on the rise, and where else should they be? Should they be looking at, should they be looking at the north? Should they be looking in Cardiff? Should they be looking in Edinburgh, depending on what happens there? What's your sense of particularly that UK and the regional markets?
I think London will continue to be an attractive market, mainly because it's a very strong economy and it's a world-class city, so that will always have its attractions to people, and they will just look at the opportunities on a sort of opportunity by opportunity basis to see whether there's value to be had. I think moving out of London, and the other interesting thing actually about what's been going on is that maybe the sort of development cycle, and I think somebody referred to it in her presentation, maybe some of the development cycle will be curtailed a little bit because there is a lack of development appetite because of maybe looking at risk through Brexit, so that could help support rents. Having said that, there'll probably be some second-hand space or grey space coming out onto the market as people seek to try and cut costs a little bit in London, but I think so I think that could support rent, and and could support liquidity in the market a little bit. So there will be opportunities. I think outside of London, there hasn't been a huge amount of development, as Michael has referred to, in the sort of major cities. And so that does, again, generates activity. I think the cities outside of London will be, and we haven't talked about the autumn statement, but they should start to benefit from some of the infrastructure and housing and some of the things that, you know, Hammond announced yesterday. And I think that will, again, you know, produce opportunities. There's a lot going on in these places. They're quite exciting. I was in Birmingham on Friday, and there's an awful lot going on there, and there's a sort of new can-do spirit about the place. So I think these cities should benefit from the fact that people are less nervous about the impact of Brexit on their local economies, and they're getting fit to go forward. So, you know, the regions are going to be an interesting place to deploy your money, probably in all of the sectors. But I think particularly from a sort of strategic point of view, the things that are going on, it will be led by the logistics and industrial sectors, but there'll be some retail opportunities and some office opportunities in these places. But again, you've just got to pick your stock very carefully and have a very good business plan to go with it in order to make money. And
David, in terms of the regions, do you think that, I mean, there's opportunities, as Simon's mentioned, as Michael's also mentioned. Do you think that increasingly the more institutional investors will be driven to those either by opportunity or by lack of core product that they can access? And do you think, therefore, that the market overall in 2017 will be taking on more risk and looking more at these regional opportunities?
I think, yes, it will be looking more at those regional opportunities. I think it's for the reasons you've outlined there, but also because when people look at the risks around Brexit, they are very focused on what that means for London. And I mean, even when you look at the office markets, even when you narrow it down as much as to financial services, then when you go to the regional cities, the financial services occupiers there are much more domestically focused. They stand to be less impacted by international regulation. Whether that's necessarily a reflection of people looking for more risk, I think it's very dangerous when people see the higher yield on offer, or they feel like the core markets are too competitive, and then they move into the smaller towns. You need to have still a coherent strategy. You need to be looking at these smaller locations, seeing if there is growth there, because often there can be growth prospects just as strong as in some of the core locations. And on that basis, you're taking higher yield, and really that's just a trade-off for having slightly less liquidity.
Okay, good. And in terms of some of the alternative sectors, and this is to anybody who wants to pick that up, really, student housing obviously been quite big here, also quite big in terms of a European side, care homes, hotels aren't really alternative in that sense, but what are we seeing for the alternative side? Do we think there's going to be an increasing focus? I mean, Will there mention more niche strategies? Do you therefore think that's going to be another theme moving into 2017, that there will be more investments into that alternative sector?
Yeah, I think that will continue. I think that's an ongoing theme now. I think you kind of summarised it quite nicely when you called hotels not an alternative anymore, whereas 5 years ago it certainly would have been an alternative. But I think you also have to think about alternatives from sort of two perspectives. We often think, oh, if alternatives investment is booming, that means people can't access the traditional stock that they want, that the market is overheating. Where in actually a lot of cases, it can be almost the exact opposite. If people are feeling uncertain, they feel like there are risks, they're looking for secure income, then it can be some of those alternative sectors that can provide those long leases, often inflation linked.
I also think there's a sort of commodity issue. I mean, the housing market has been one where we've all had a lot of our personal wealth invested, and those of us who are sort of middle-aged, and there aren't that many in the room, you all look like nice young people, but I mean, it's more difficult now for people to get on the housing ladder as early as they could before, so people aren't coming out of university, renting for 4 or 5 years and then buying. They're renting for 10 or 15 years, and I think, you know, we're becoming much more similar to the way the world has worked in places like Europe now. And the institutional market for residential property in places like Germany is very well developed and a very large segment of the market, and I think that is going to happen here. We're seeing a lot of developers turning from some of the more traditional types of property into the PRS market, and there is an institutional appetite to buy the finished product. And I think that's for two reasons. One, it's going back to sort of trends in society, which I've just referred to, but the other is actually the income's pretty secure if you've got a good product in a good location, because, you know, instead of a very binary risk on one tenant in an office building, say, or 2 or 3 tenants, you might have a block which has 200 or 300 tenants in that block. So you are going to get some voids, but the chance of the building absolutely emptying out is very small. So people are sort of paying for the security of income that having a very diversified set of covenants brings, and I think that's attractive as well to the funds. And what we are seeing is one of the few areas that the domestic funds are actually still investing in is the PRS sector, and they've been doing that now probably for the last 2 years, and I think that will continue. So it's not really alternative anymore, it's they're getting their allocations up to where they need them to be, I think, and there's still a way to go.
Okay, good. And so in that sense, maybe that's moving to a slightly more US model where some of the things that, you know, so PRS here was not an institutional product until relatively lately, whereas in the US, multifamily has been there for years and years and years. Do you think there's more kind of trends coming from the US in terms of how we perceive the markets that we're looking at?
Well, I mean, PRS is the obvious one. Multifamily, there are various derivatives of multifamily, as I've learned over the last few years in the US, but multifamily is and PRS is the obvious one. Look, can I just dwell on PRS for a second? We look very closely at that market. One of my old job, we within Global Investors, we ran a 2 billion resi fund in Holland, which is, you know, a hugely mature resi market. And I think the smarter minds in the UK have allied themselves with some of that Dutch or German expertise. So APG Granger, Bill Hughes at L&G with PGGM. So let's learn from people who've done it before. Now, that resi investment fund was horribly boring up until the crisis and wonderfully boring during the crisis. So I think suddenly the institutional world in the UK thought, hang on a minute, that's quite useful, steady income. So going on to other trends, logistics, I mean, there have been various references to it. I think it's a great sector. It's quasi-retail now because so much of the storage is going on in big boxes in distribution locations than in the back of shops anymore. So, and I think that we're seeing a lot more value-add investing in logistics in the States than we do really here. It's been left to the private equity funds to do that take that type of risk in logistics, and I think slowly but surely you will see some specialists come into that market or derive away from the core end of the market. A client of ours, Exeter, is just about to do exactly that. They're very strong in the States and they're building up in Europe. So let's see whether that works. And in retail, I think actually the story's not dissimilar in retail. You know, shopping centres are challenged by e-commerce. That's been evolving over the last 4 or 5 years. But ultimately, I think the mega malls are doing very well in the States. The lower malls, I mean, I don't know whether you've ever walked into a mall that's died, but they exist in the US because there's so much land and therefore you can develop more easily. But that middle section, I really like, the unloved shopping centres, and there are some experts in the UK and in continental Europe who will pick out the ones that can recover and avoid the ones that are dying slowly but surely. And I think that's an interesting trend that's going on in the States and Europe in a very similar way. Final one is student housing. Slightly different in the US because they've got more land, and therefore the student housing market is tighter in the UK and Europe. You can see people like GIC just did a big deal with GSA, Global Student Accommodation. They they are going into those alternative sectors. They're not really alternative anymore. They're mainstream, but they're smaller. They just like the income, the diversification of income. You know, you're seeing them doing big deals with P3 in logistics. So again, going to higher income sectors and investing heavily.
Okay, good. Has anybody got any questions that they want to ask? Please let me know somehow. And you've got time over the next 10 minutes to come up with some different questions, any thoughts that you've got. I've got some quick ones that I want to check. In terms of yield, where do we think we're going to be? You can give us your estimates of where yields are going to move, up, down. Where do we think, Michael?
Minus 40 basis points for prime in most European core markets.
Okay, all right. Any other thoughts on
by end of 2018?
By end of 2018. Okay,
yeah.
So we won't be able to come back at the end of 2017 and check that. You've given yourself a whole 24 months there.
Yes.
Anyone else views on where we'll be with yields?
I think across the core prime markets, I'd say there's still a little bit of scope for yield compression. Whether it would be quite as much as, I'd probably go a little bit less than 40 basis points myself.
Will confirm to us that debt is becoming more expensive. Michael mentioned to us that in the space that he's active, that is necessary, but also a bit more challenging to find. It all sounds to me like it's a good opportunity for debt funds to pick up, the tab here. Can I ask the panelists, and especially Will and Michael, what do they see with regards to the availability of debt coming from alternative lenders? As I also recall last time in a different panel, Will mentioned as well that mezzanine lenders were even more active. So can we get the latest on your reading with regards to the availability of debt from alternative lenders? Thank you.
I think it's a great opportunity for alternative lenders in the UK. You know, there's a lot post the global financial crisis. They then found it quite difficult, but you know, there is a massive trend of deglobalization. Just think where, you know, RBS used to be in terms of offices, and it's a very, very small subset of where they are in the world now. And against all the global, you know, trends has been over the last 15 years, banks really have been type of, you know, treading backwards in terms of this deglobalization, largely because governments have supported them, and therefore if the governments are going to be supporting these banks, they want the effect to be local, not in some faraway country. So I think that there's a lot of opportunities for, you know, Longbow, these type of organisations in terms of debt funds. Absolutely. We would certainly borrow from them, so long as we felt they understood real estate. You know, that's a critical thing that we don't look at any lender to us unless we feel they understand, you know, the real estate, and, you know, if things get tough, that hopefully they're going to be with you. Okay, good. Any other questions?
Can I comment on that?
You can. Sorry, I'll come back to you in a second. Will, you can. Yes, that is allowed.
We've done like the sector, MES, transitional real estate, lending on transitional real estate. We've raised a lot of capital for two funds in the States. We've been working with Cerberus in Europe and the States, and it attracts lots of interest from around the world. So there's lots of Asian money going into that, those funds, lots of US money. European investors are slightly more reticent about it, but I think wherever it might be, if there's expertise in the organisation that's trying to raise the capital for MES debt at the moment, it's very attractive.
Okay, good. Yes, go ahead.
I'd just be wondering what the panel thinks in terms of some of the southern European markets and the central European markets, if there's value there, and if so, where specifically?
So southern Europe, CE.
Well, I can start with that. We don't look at those at all, and maybe that reflects my view. It's just too much for a small business to handle all those other countries. But we've always, as a mentality, as a business, focused on liquidity, and so that's really why we've chosen to be where we are currently. Sorry.
I think, yeah, certainly opportunities in both markets. I think maybe we're a bit past the point of lumping all of Southern Europe in together now. It's really it's a matter of looking at the individual growth prospects, because really that is the Southern European play, the same as the CEE play. You're looking there for the growth. So I think grouping them all together is a bit risky. But yes, certainly when you're looking for growth in a low growth environment, then they are some of the places that you will go.
And Will, what's your sense of it? Obviously, Spain now very different to Italy, to Greece, and you've got CE, you've got Poland, which was more
and
Northern Europe.
SEE, as I heard, the Southeastern Europe.
Exactly.
Which is the bit that not many people have invested in.
Montenegro
and Croatia and Bulgaria and places like that. Yeah, no, I've met a manager who was trying to promote that area recently. That's a tough sell.
Although there is South African money going in there.
There is, yeah. Yeah, no, he highlighted that very clearly. So, anyway.
I think I met the same person.
The early mover advantage, when I was with Global Investors, we bought some Italian and Spanish shopping centres, core shopping centres, in 2013 when we were playing the cycle. And that's played out pretty well. I think it's now down to rental growth. We met a manager recently, in fact I'm meeting another one tomorrow, promoting a Iberian Peninsula fund. So the easy cap, sorry, it's not easy, but the capital growth story is kind of gone to a certain extent. So you're now down to, what it sounds like Michael does in some of the markets you work in, rental growth, working the asset, proper asset management. And so there is capital attracted to those markets, but around real experts who can prove they're real experts. It's quite a difficult sell, still quite a difficult sell outside of Europe, though. There's just too much perceived risk. And I remember being with a Chinese investor in Madrid a couple of years ago, and he asked a very well-versed researcher, Spanish-based researcher, to give him the real reasons why the Spanish economy would grow, and he was struggling. Under heavy questioning, this guy was struggling. So makes you wonder.
Okay, well, that's a question I'll have to ask when I'm in Madrid, obviously. Good. And any other particular regions? Nordics, do you think? I mean, are we now... Russia has not been on the map really for some time. Turkey now seems to be pushing itself off the map. Are there particular regions that you think will or will not be investable next year?
I'm surprised by Nordics. We looked at the Nordics with a couple of managers. There's an awful lot of debt in those markets. When you sit with a manager who seems to be pretty comfortable about going to 75-80% when the rest of Europe is getting nervous above 50, maybe 60. There's a lot of debt. But I have one of the Dutch investors who, to us, seems a really conservative investor. Just put another 50 million with Genesta, good manager, but going into markets that are pretty highly leveraged and as far on in the cycle as anywhere in Europe, frankly. So, but people are still investing.
Okay, good. Does anyone have any other questions? I've got my traditional one, which I will pass on to you, just so that we can keep this for consistent, which is just to force you to come to some conclusions that we can then check next year. So it's got to be invested in 2017. It's got to be 500 million. It can be in the UK, or it can be in the UK and continental Europe. But how are you going to get me? You can decide my levels of risk, but how are you going to get me the best return in 2017? I'll start with you, David.
Obviously a very difficult question. I'm going to somewhat sidestep it. Obviously, I can't tell you all of our secrets. If I look away from direct property, then actually I would say I see a lot of value in the UK REITs at the moment.
Okay, UK listed. Will?
You've been listening to David Atkins of Hammerson, haven't you? He would say the same. Look, I've covered some of it. I would probably put half of it in income generation, which is safer, so logistics or student housing, and I'd probably put the other half in the value, what I see the value add sectors, so unloved shopping centres, maybe developing logistics in very undersupplied markets.
Okay, good. Simon?
I think there's opportunities in the UK, certainly, which is the market, obviously, that we specialise in as I sit here. And you've just got to pick your specific stock. So I think I'd go on a very stock-specific sort of strategy and just look at the particular opportunities of the purchase available, really. I think riding sectors and riding the market is quite risky at the moment because the market's probably in a part of the cycle where you can't make money out of doing that. So I'd just go for a very careful stock selection policy and put it into a sort of a range of markets across the UK, London and outside London.
Okay, good. Michael?
Well, I'd back good asset management into Germany, Luxembourg, maybe to a limited extent France. I'd certainly be putting some money, assuming your question in terms of best returns, you mean best risk-adjusted returns. I'll put certainly some in a type of debt mezz fund. In terms of the UK, I would just keep focusing on the fact that Brexit's a huge opportunity for producers of goods for the UK market. Suddenly all their competition has been, is potentially going to have tariffs, and it's certainly 15% worse off in terms of exchange rates. So I think it's easy to just focus on the negative aspects of Brexit, but there's some businesses that will do tremendously well out of just what has already happened in terms of the impact upon the referendum. And I would begin to do a bit of research on bonded warehousing. Really interested in terms of storage of goods that are technically outside UK tariffs, and possibly also look at offshore assembly, distribution, warehousing, where a small element of the goods may be actually produced in the UK, but the other aspects of the assembly bypass the UK for the assembly to avoid tariffs.
Okay, good.
Can I tell you the wackiest sector that we've looked at recently? And this is completely off page, but anyway. And we recently had a manager come to us in the States because a lot of states have been making cannabis legal, right? 8 now make it. A lot have done it for medical, but now more and more are making it legal. And the real estate industry is beginning to react to it, and is trying to work out what real estate they will need. And these guys were talking about, this is going to be a cannabis-producing real estate fund. And I mean, this is real. We're sitting there going, have you been smoking something? But it was real. So anyway, that's one off the page for you.
Good. Look, thank you very much. Very interesting discussion. Thank you for your presentation as well, Sukhdeep. I'd like you to join me in thanking both yourselves for your thoughts and for attending this morning, and also to the panel. Thank you very much.